Have you ever looked at your bank account and thought, that's my money sitting safely in the bank waiting for me? Here's the uncomfortable truth. It's not really there. The number you see on your screen isn't a pile of cash with your name on it. If everyone walked into their bank tomorrow and demanded their money, the system would collapse in hours, because that money quite literally doesn't exist. This isn't a glitch, and it's not a conspiracy theory. It's how the global financial system was designed. And the mechanism behind it has a name: fractional reserve banking. It sounds complicated, but it's one of the oldest and most powerful illusions in history. The silent engine that fuels debt, inflation, and the illusion of prosperity. To see where it began, we need to rewind to medieval Europe, a time when gold and silver were real money. The wealthy kept their coins or jewelry locked away, but carrying treasure was dangerous, so people started leaving their gold with goldsmiths, craftsmen who owned strong vaults. In exchange, they received a paper receipt, a note promising the bearer could return and collect their gold later. Over time, people began trading those paper receipts instead of the gold itself. After all, the note represented value, and it was easier to carry. That's when the trick was born. Goldsmiths noticed that almost nobody came to withdraw their gold all at once. If they had 100 clients, maybe 2 or 3 would show up in a day. The rest of the gold just sat there. Then came the realization. They could issue more receipts than the gold they actually held. If they stored 1,000 coins, they could write 2,000 paper claims and lend the extra notes at interest. They were earning profit from gold that didn't even exist. As long as everyone believed their gold was safe, the illusion worked. Eventually, this clever trick evolved into banking. By the 1600s, the practice was institutionalized, and governments joined in. When England's monarchy was drowning in war debt, the Bank of England was created in 1694. It didn't serve the public, it served the crown. The bank lent the government more money than it possessed, charging interest. That interest was paid by ordinary citizens through taxes. Sound familiar? It should. Every modern government still does the same thing. Early American banks followed a similar pattern. They issued notes backed by gold, but soon realized they could print far more than they actually held. Whenever panic hit, depositors rushed to withdraw their money, and discovered it wasn't there. Rather than ending the system, governments doubled down and created central banks to support the illusion. Their message was simple. Even if the money isn't real, your belief will keep it alive. Now picture this in today's world. You deposit $100 in your bank, assuming it waits there for you. But the bank only keeps a small portion, once about 10%. As reserve, lending out the rest. That $90 might be borrowed, spent, and deposited again elsewhere, where 90% of it is lent out again. By the end of the cycle, your $100 has multiplied into nearly $1,000 circulating in the economy, but only $10 of it exists as cash. Here's where it gets wild. Since 2020, U.S. banks are no longer required to hold any reserves. The reserve requirement is 0. They can lend virtually unlimited amounts, restricted only by internal risk controls and global standards known as Basel rules, written by unelected regulators in Switzerland, not by your government. Today, banks don't lend from deposits. They lend first, and that act creates new deposits. When you take a mortgage, the bank doesn't move existing money. It types new money into existence. That digital balance exists only because you promise to repay it with interest. Over 90% of all money in circulation isn't physical cash. It's credit, born out of debt. That's why every dollar in existence represents someone's obligation to pay it back. This design leads to 3 inevitable outcomes. First, an inflation. As banks expand credit, the money supply grows, diluting the value of each dollar. Prices rise not just because of supply and demand, but because the money itself loses strength. Second, perpetual debt. Since money is created through loans, there's always more debt than actual money to repay it. Interest ensures the books never balance. Someone must always borrow more to keep the system from collapsing. Third, concentration of power. Banks collect interest on money they never truly owned. Governments rely on this mechanism to finance wars, welfare programs, and bailouts, without directly raising taxes. Meanwhile, those who own real assets, property, stocks, commodities, grow wealthier as inflation pushes prices up, while workers see their purchasing power shrink. History repeats this same pattern. In 1929, banks had issued far more credit than they could support, fueling the stock market bubble that led to the Great Depression. When trust vanished, the illusion crumbled. In 2008, the same principle triggered the global financial crisis. Banks multiplied credit through mortgage-backed securities, building a house of cards on top of promises. When borrowers defaulted, the structure nearly collapsed until central banks stepped in, printing trillions to keep the game alive. The truth is, today's system doesn't rely on reserves at all. It runs purely on confidence. From New York to London, from Tokyo to Frankfurt, the foundation of modern finance isn't gold, productivity, or even savings. It's belief. But here's the problem. The system can't survive if everyone becomes debt-free. If every household paid off their loans tomorrow, the money supply would evaporate overnight. The economy would freeze and the illusion would die. Your participation, borrowing, spending, and trusting, is what keeps it alive. So what should you take from this? First, money isn't wealth. True wealth isn't numbers on a screen. It's land, knowledge, skills, and independence. It's what holds value when paper promises fail. Second, debt isn't neutral. It's the bloodstream of a system designed to favor lenders and governments over ordinary people. Third, inflation isn't an accident. It's intentional. It's the built-in feature that ensures you must run faster each year just to stay where you are. This doesn't mean doom is inevitable. It means awareness is power. If your money is born as someone else's debt, real freedom begins by stepping outside that cycle, by building wealth that can't be printed away. History doesn't repeat, but it rhymes. From the goldsmiths of medieval Europe to the panics of the 19th century, from the Great Depression to the crash of 2008, the pattern is the same. Too much promise, too little reality. So, the next time you check your bank balance, remember, most of it exists only in theory. It was never designed to secure your freedom, but to ensure your participation. Understand the trick and you can protect yourself from it. Ignore it, and you'll remain just another player in a game the house always wins. If this gave you a new way to see money, subscribe to Financial Origins, because history doesn't just tell us what happened, it shows us what's coming next.